What does the RBI do? What are the functions of the RBI? Of which we covered some. Number one, it is the issuer of currency. You know, coins and 1 rupee, that is the finance ministry. You know, that is historical. But any federal bank, any central bank of a country, fundamentally is the legal authority to issue currency. So, and we know all that. Our friend already asked about gold. And we know everything about when you print, how much you print, why you print, all that we know. That's the primary, the fundamental, number one work of function of the RBI. The next one is it is a debt manager of government. Central and state government. So I'm the central government, you people are state governments, that's the RBI. So I tell the RBI, can I get 100 rupees? You please float securities on my behalf, treasury bills, bonds. Please pick up 100, sell it to the market and get me the 100 and whatever the terms. You are the state governments, you will tell the RBI, okay, find me a market for my securities, SDL, you will see the graphic. State development loans, states can't float the treasury bills, they can float the long-term bonds, that is the, bonds. And so you sell, what are the limits that the RBI will tell you? For the union government, there are no limits. States, there are limits because there has to be fiscal discipline. So RBI manages my debt. Now there is a problem here. You know, whether there is a problem which is a real problem or a perceived problem or feared problem. Is there a problem? There may not be. Isn't there a problem? There may be. I'll tell you what. It is. So you are the government, RBI is there. Sir, you get me a loan from the market. Sell my securities. You are my debt manager, do it. But remember, RBI is also the monetary authority that sets the rate. It used to, not anymore because MPC has come in. So there was a problem that RBI would arrange the rate in such a way that it helps the government raise the loan cheap. Inflation is there, 6%, rates have to be raised. But if you raise the rate, when I sell the government security, I have to pay more to the market, which means it will be costlier for the government. I have eaten the namak of the government and I have to manage the debt of the government cheap. So even if there is inflation, I won't raise the rate. There is a contradiction between being a debt manager and being the rate setter. That is why the rate setting function of the RBI got taken away and it is given to MPC because the contradiction was on the face of it hurting, and so you decided to take away that function and leave the rest of the functions with that. So that is a debt manager. And I already discussed, rate setting, etc. That goes to, but the implementation is still with the RBI. Though the function goes to the MPC, the implementation is still with the RBI. RBI has to operationalize. Even within the MPC, RBI is half. And if there is a tie, it is the chairman, RBI governor, who breaks the tie. So even while you have given it to the MPC, the role of the RBI is quite substantial. For all your CRRs and SLRs, what you call the regulation, ratio setting, It's the author of the monetary policy. All the instruments of the monetary policy are activated or deactivated by the RBI. So that is another. That is the monetary policy, author of monetary policy. Five is, it is the regulator. You want a bank license on tap. It's not that I'm going to issue. I've already issued, and after, I don't know when I'll issue. No, on tap. Whenever there is a request to open a private bank, I'm ready. I'll see if you are eligible and I feel the market needs you. So RBI gives license to banks, number one. License to open the branches, number two. ATMs, number three, and all that. So, regulator. Then RBI is the clearing house. Clearing house. Clearing house means I'm the RBI, you're the commercial banks. All of you have accounts with me. 100 rupees, 100, 100. Now somebody has an account in A bank. He is giving check to somebody who has an account in B bank for 1 rupee. So from A to B, 1 rupee has to be transferred. B has an account in the other bank. He has given a check to somebody who has an account in A bank. So these are all banks. End of the day, there are checks, settlements, one bank to another. 100 rupees from A to B have to go, 25 from B to A have to go. I'll net it out and I will see 75 goes from A to B. That is the function of clearing house, settlement, netting. So that is settlement, clearing house. And then there is, of course, custodian of forex. Remember, they are reserves, not resources. You are not expected to use that, except for, some purposes. Somebody said, why not we build roads with that? To build road, somebody from outside India will come, China will come, Japan will come. They will bring their money. They'll bring their money. They'll bring yen. Foxconn will come. He'll build, smartphones here. He'll manufacture, assemble. Whatever he does. He'll bring his money. He'll convert them into rupees and he'll do his work in rupees in India. And you will pick up the forex. RBI will pick up the forex. Forex is forex. You never have enough. If you have $3 trillion, $2 trillion, don't acquire. If you acquire, if you don't need, you don't acquire. Why are you saying let's spend it on roads and buildings? That expenditure is in rupee. Print rupee, collect tax and build it. But then don't say spend your dollar on building the road. That's not the right link at all. We need that for more precious purposes, like dealing with the world and all that, BOP. So, custodian of forex reserves. Custodian. So that is another. Still one more is financial inclusion, which means extending formal banking operations to all so that they can open an account. They have access to loan, micro insurance. They can deposit their money so that that money can be used for the good of them and for the rest of the society. So financial inclusion, Jan Dhan. And then RBI also has developmental role. Developmental. It will ensure that MSMEs come up, and so on and so forth. Developmental. All this the RBI does, and now you will see all this in a graphic, which is a hangover from the day before or the day before. Yes, clearinghouse. Lender of last resort, I'm coming. Please go through. Banker for the banks. Banker and debt manager, government, and the rest. Lender of last resort, I'm coming. Then there is going to be a question on that. I will clarify to you once and for all. Dharmendra ji, dollar. Dollar. You love dollar. So, take this off. I will talk about lender of last resort. We will keep it somewhere here. Lender of last resort. See, I am the central bank, you are the commercial banks. I'm a regulator. I have no interest in giving you money so that you can lend it for a cement factory. No, nothing. For that, there are multiple other channels are there. Stock market is there, global market is there, bond and all. My job is to see you carry on. You have no difficulties and reasonable levels of commercial hurdles are not there in this financial market. So what do? You want money? I can give you. For how long? 24 hours. More? I can. Little more I can. But I can't lend you medium and long. I can lend you short, that's overnight. Which means you are desperate and drowning. I can give you a lifeline. That is through my repo rate. You still want a little more through my MSF, I can give you money. And you've got some money to spare, I can take that. And I want to take that away so that the system is fine. Basically, I will give you money so that you operate stably. That's all I'll do. And if there's a bank sinking, people are on a run, bank run it is called, they want their money out and withdraw, long queue and all that. I'll help you out. Maybe I'll help you out. So when the RBI lends to the commercial banks on an overnight basis to meet their financial needs, emergency, or when they are faced with a financial crisis due to a bank run, this is essentially the lender of last resort function, in which the majority of the function is repo rate. That is a lender. Last resort, you try your luck here, there, everywhere. And if you can't get anywhere, I am there. You won't fall down, I am there. That is it. Like that film Jawan, Shah Rukh Khan says, I am your father, I will always be there for you. That is the relation that the RBI has with the central. I will always be there. I'll bail you out. Lender of last resort. But I'm not first resort. 100 guys. Last, if you are going bankrupt, come to the RBI. That is the lender of last resort function. It's not lending to the government and all that. No, no. This is the technical meaning of lender of last. So, I want to show you I want to talk about it and then show you a graphic related to Forex, exchange rate stability, etc. See, it's like this. You know, last year, not October, a little earlier, about June, July last year was very tough for the rupee. America was raising the rates after seeing the inflation go up and up and up and up to 8 or 9. Then they suddenly woke up, inflation is so high, people are hurting, let me get in, raise the rate, raise the rate, raise the rate. So people holding financial assets all over the world, you know, the loose money, fickle money, money that floats all over the world. You know that money, hot money. So they thought if America is giving us 4%, 5%, let's go there. You know, safest in the world. So people were converting the rupee, as it matters to us, into dollar. So rupee 80, 81, 82, 83. That's too serious because, you know, if the rupee depreciates, loses its value, then imports are going to cost you more and that will inflate the economy and create multiple channels, ripple through the economy, you know, creating pressure and, you know, other problems. Multiple problems. We'll see. So RBI had to get in. But if the RBI is seen to be buying the rupees openly, then America is watching. You are called a currency manipulator. Because, you know, you are intervening into the market to change the rate, interfering with the market dynamics, and that is currency manipulation. Usually the manipulation is to weaken it, but if you are getting so weak on your own, then I have to strengthen it. So even that will be currency manipulation. RBI goes into the market, Forex market, buys and sells in a manner that is aimed at getting a certain rate. It does, RBI does, but RBI does not aim for a rate. RBI only aims at stability, exchange rate stability. But then you have to look legal. If you are not legal in the eyes of America, you have to look legal at least. So RBI said, okay, I'm into Forex operation. I will sell you dollar. You are the market. I, the RBI. $5 billion I will sell by the rupee. So demand for rupee. Rupee won't fall so much. Without this, it would have fallen to, God forbid, at least as of now, 84. Last year, 84, signals would have been devastating. Financial earthquake. World is watching. So RBI went in to the Forex market. $5 billion I'm selling. I'm buying rupee. You know, stopping the free fall of rupee. So, is it a plain case of selling? No, no. I'll come to you in October 23, which is now. I will come to you in October 23 and I will, you know, buy back the dollar. I'll buy back the dollar. So, you picked up the rupee, bought the rupee, sold the dollar. You're in a swap. Take this dollar, give me the rupee. Stabilize the rupee. Will I buy the dollar back? Yeah, I will. That is swap. I will again come to you somewhere October and then return the rupee and take the dollar back. Now, you know, 83.25, it's okay. But then market is a little worried because we are not too, again the Gaza thing has come, unsettled a bit. So this is the classical case of a swap, currency swap within the country. There's a currency swap with Japan, Sri Lanka, SAARC swap is there, Japan is there, and we have a currency swap, primarily Japan. We got one with Japan. So there what do? You are Japan, I'm India, you are worried about your balance of payments with the world. I'm worried with the world about the balance of payment. I may need foreign currency. You may need foreign currency. You won't need. You are a foreign currency. Yen is a foreign currency. But you are a friend of mine, strategic friend of mine. Our securities are linked. So you would like me to be financially stable. You don't want me to go down. So I told you, let's get into a swap agreement. Whenever I or you, if we are in trouble, not having enough forex, I will bring you up to 75 billion dollars worth of rupees, you keep it. And then you, in exchange, that is swap, you give me dollar. I'll keep this rupee with you, take the dollar equivalent, give me the dollar. And what is the exchange rate? Whatever that is prevailing. After a while, I will return the dollar, take the rupee back. And I'll pay you interest for that. So give me dollar, number one. Keep the rupee as the collateral, number two. I'll pay you interest on the dollar that I'm borrowing from you, number three. Rupee is only collateral. And then when I return the dollar to you, I'll return the dollar to you. I took the dollar, I'll return the dollar. When I return the dollar, I'll take the rupee back. And this is basically a foreign currency loan that you are taking from Japan, vice versa, on which you are paying interest. So that is an external swap. This is an internal swap. Internal swap also, you have done the same thing. Kept the dollar, took the rupee, returned the rupee, took the dollar back. And here you are not taking loan, there you are taking loan. That swap is a loan. This swap is not a loan, it's a buy and sell. That's not a loan. So, okay, that's the difference. I hope you got it. Yeah. Now you see the graphic. Last one I think I sent you. One of the, yes. Absorbs rupee liquidity. That basically means create a demand for rupee, ensure it doesn't fall, may even rise a paisa or two, because there is relentless demand for dollar and the rupee is tripping down. So what do? Take the rupee, create demand for the rupee. So 84, 83, whatever, all that. So at least you see that the rupee doesn't fall. A lot of guys want dollar, you want rupee, net it out and the rupee stays where it is. If nothing better, that's what you've done. But then you don't want to be seen as a manipulator, therefore you gave it a legal look. Don't have to say it, between you and I am saying, because you need to have a feel of what's going on. That feel part, you have to go behind the curtain. So the feel part. Otherwise, if you say this, you are the best. Yeah.
What is maturity?
What's what? Maturity. You put for 100 rupees in the bank for 6 months. When 6 months expire, maturity. I bought rupee, I gave you dollar. My swap is for a year. Last April it happened, 22. April to October. So you count April, May, June, July, August, September, October. 1 year and a half, 18 months is the maturity. So you picked in April, please. This is October. So maturity date is 18 months. Yeah, please.
So can you please again repeat money dollar swap?
Internal or external? See, internally, rupee is crashing, and it will stop crashing when you demand rupee. If there is demand, the price will rise. If there is no demand, price will. The demand for dollar from the side of the rupee, dollar will strengthen, rupee will weaken. I can't afford a weak rupee beyond a level. I want the rupee to weaken over a period of time, not fall in a, freestyle. So RBI goes to the forex market, you are the dealers. You keep this $5 billion with you, give me the rupees. $5 billion worth of rupees is one hell of a lot of a demand. Sort of, in normal language. So rupee did not fall because RBI artificially went into the market and created demand for rupee by selling dollar. Selling dollar. Normally what do? You buy dollar. Why do you buy dollar? In times like this, you can sell dollar and keep the rupee, stable, less weak, etc. So, and did I sell one way? No. I sold you, wrote an agreement with you. Take this dollar, give me the rupee. This is a swap deal. I'll come back to you when the deal matures, which is October, and I will give you the rupee and take the dollar back. Yeah?
Yes, sir.
That's the home. With Japan, you just keep the rupee and take the dollar, pay the interest, return the dollar and take the rupee back. It's a loan based upon the domestic currency collateral. With Japan, 75, up to 75. But there are some rules within rules and all that. You're okay with this?
Yes.
Take your time. Take a minute or two.
So in the external swap, during the time of maturity, the rate of return will be the previous one?
You will write there. You will write in the swap deal. Today I am buying at 83 something. When I return, I will return at this rate. Market rate or this rate or that rate, whatever rate, the guy who gives you the rupee for dollar, you deal with him, sit down. He knows the market, you know the market, sit down and work it out. Yeah? Take your time, take a minute more. It's not that this question is going to come, please, for God's sake. It's just that it helps you, understand better. This is your quick revision notes. Quick revision, QR code. So that was, Dharmendra ji, right at the outset you had shown a graphic, fiscal and monetary policy comparison table. Yeah, let's see that now. Now that we know the monetary, now that we know the fiscal, let's compare the two. See what it's all about. This is the comparison. Remember, in a multiple choice question, this is an excellent question. Inflation, this and that, growth or exchange rate stability. What's the role of fiscal policy? What's the role of monetary policy? He'll try to confuse you. But with the help of this table, you are impossible to confuse. I think, somebody wanted visibility. Okay. But then the beauty of the graphic is gone. The integrity. Is it okay now? Visibility?
Yes.
Yeah. Take 2 minutes, 3 minutes. Examples always have to be brand new, the latest examples. Here the example is the repo, this and that, 6.5, starting from May 2022 all the way to July 2023. You've been raising it by 250 basis points. Basis point is 100. 100 basis points is 1 percentage point. You break it up into 100 parts, a single percentage point, because To convey the gravity of what the central bank is doing, if you can magnify by 100 times, then people will come to know that you are up to something. Otherwise, if the headline is RBI raises the repo rate 0.25, you don't register. For you to sit up and take note, 25 basis points. Yeah, they're doing something. After all, remember one thing. RBI action is to manage your expectations. Expectations are everything. Psychological game it is. Whether the RBI is going to bring the inflation down, what can the RBI do? You please tell me. Guys are fighting in the Middle East. What can the poor RBI do? Yeah? It can't do anything. If some Ukraine is going on, what can it do? Nothing. But it can't say, I can't do nothing. It has to say, yeah, I'm doing, don't worry, we are in charge. Everything is you will manage. So keep doing something, manage expectations. Expectations are very important. My intention is good. I'm helpless. I can't tell you I'm helpless. I have to convince you I'm doing something. Manage expectations. So for that, the repo thing. Here, the fiscal actions. You can give any number of examples. COVID-19 is a pretty decent recent example. Instead of reverse repo, the examiner has no problem at all. If you can say SDF, examiner will, yeah, this is it. I think so. Shrink it a bit so that full view. Yeah. You're okay with this? Or you can take more time. I'm not in a hurry. We're not doing a ritual.
Sir, is there any restriction put on RBI under the FRBM Act?
See, RBI is the monetary authority. FRBM is for the government. The restriction that the RBI has is it can't be the primary lender. When I want money, RBI can go to the market, pick up the money and pass it on to me. RBI can't print and give me unless we are on the escape clause, which is invoked when there is a crisis, COVID, etc. So your question is, how does the RBI come in picture under the FRBM?
Yes.
It can't print and lend to the government. It can only borrow and lend to the government. It can print and lend only in an escape clause, which is when there is a financial crisis. You got it now?
Yes.
Yeah. So, now I'm going to tell you something that could be important for your main, and as you know, whatever is important for your main is important for prelim and vice versa, for God's sake. Let's not segregate the two. This is analytical, that is also factual. That's where analysis and facts. See, so RBI is making the monetary policy to cool the prices, let's say. Inflation is very high, you want to cool it, raise the rate. Inflation is very low, time for growth, let us reduce the rate. It does all this. Now, RBI is lowering the rate or making the rate higher. Make the rate higher so that the banks pass it on in the form of higher deposit rates so that elderly people are happy, small savers are happy, etc. And hike the rate so that, the hiked rate is passed on to the people who want to save with you, deposit rate. So basically, you want to cool the prices, you want to help the MSME, you want to do this. So, you lower the rate. Whether the banks will pass on the lower rate will depend on a lot of factors. Number one, commercial banks are there. They are sitting on tens of lakhs of crores of rupees of non-performing assets. That is, you lent the money, you are not getting the money back, he is not even paying you the interest, and that is a non-performing asset. You are sitting on lakhs of crores of rupees of NPAs. RBI lowered the rate, but you can't afford to lower the rate. 100 in 100, 10 are locked in NPA. What that would have fetched you, you have to collect from this 90. So if the RBI reduces the rate, you can't lend at the lower rate because you have to recover what you are not getting here from here. So the rates will always be high. That is one structural factor. Another is, okay, you lower the rate, but rate is only one. There is an MSME. My heart is bleeding. But my money is not my money. My money is the money of the public. Here is an MSME. Credit worthiness is not very high. And depending upon your credit worthiness, I'll fix the rate. You're very credit worthy. I may even lend you at 8 or 9. Not so credit worthy. I will charge you 11 or 12. Irrespective of the RBI lowering the rate, I'm not enthusiastic about lending to MSMEs because they otherwise are not credit worthy. So monetary policy transmission depends upon non-rate factors. For example, rates are low, but the market is shocked by defaults. For example, Satyam Computer Services. That was a long time back. So if the markets are in a condition of shock because of the default on a large scale, even if the rate is RBI lowered the rate, I won't lower the rate. I won't even lend to begin with. So monetary policy has to transmit so that the benefits accrue to the people, but whether it does transmit or not depends upon non-rate factors. So what is the RBI doing? RBI has done 3-4 things. I'll explain that. Though I don't have a graphic for that, I thought I'll show you the graphic while dealing with banks. See, there is a commercial bank. You know, there is a commercial bank. There is a rich guy, there is a non-rich guy. The rich guy, I'm a commercial bank, if I lend to him, I'm sure he'll give me, though that's wrong because all the guys, Malayas are not a, so all the guys who don't return the money are super rich. But then okay, rich means okay, Reliance. Oh, some example I have to give you. If I give Reliance money, you know, in the Jamnagar, the only bank that will be there is my bank, number one. Reliance will certainly give the money back to me because they have no liquidity problems, number two. The loan I give is safe. Therefore, banks give to the Reliance at a much lower rate. Yeah? So, you know, I'm giving you, what is my, what they call, prime lending rate? Prime lending rate is a rate at which the best of the borrowers are given credit. The best borrowers. Let us say that is, you know, I'm just giving one number, 9%. Prime lending rate is 9%. But here is Reliance. Here are the Mahindras. I will lend them sub-prime lending rate, sub-PLR. But then here are the micro, small, medium enterprises. They are the ones who are driving the economy all right, but their credit worthiness. So here I am missing 1 percentage point because I played a little accommodative to them. I will charge them for that. So RBI notice what the hell is going on. I am lowering the rate to favor these guys. You are favoring these guys and then you are charging these guys correspondingly higher. So RBI said, fix a base rate. Fix a base rate, that is, fix a rate below which not even God will be lent. Because you are lending sub PLR, you are having to overcharge the MSME. Fix a base rate, whatever. You are banks, you fix a base rate. You fix a base rate. SBI, ABC, XYZ, you fix a base rate. Bank specific base rate. Don't go below that, because if you go below that, you're overcharging the other guys. For whose good, I have lowered the rate. So that is how RBI thought it will ensure that the monetary policy transmission is effective. Otherwise, I want you to lend at a reasonable rate to the MSME. You are not. So monetary policy is not transmitting. So I'll make sure that you will, by prescribing a base rate that a bank fixes for itself, every bank. Again, you see, what is a bank? You guys want to make profit. That is why you exist. RBI is nothing. What is RBI in front of these banks? Government officers. They are the entrepreneurs and all that. So they know how to defeat the RBI's purpose if their profitability demands it. So they were not passing it on even then. Then the RBI wanted to make sure that it goes through. It introduced what is called marginal cost of funding lending rate. Marginal cost of funds lending rate. Okay, I'm a bank. I have branches. I have staff. I have overheads. I have the cost of capital. I'm giving to the guy who saves with me 2.5, 3, 3.5, 4, 5, 6, whatever. My cost of funds, my cost of operation, and some return I need. Put all that together. This is the cost. This is the cost of mine. Today the RBI lowered the rate. Today the RBI hiked the rate, either way. So my cost of funding is X. Repo rate has been tweaked. Factor the tweak, X minus X plus. If the rate has gone down, X minus. Rate has gone up, X plus. So RBI will watch the banks that marginal means whatever, the extra. This side, that side, extra. The next change, that is marginal. Incremental. So you got your MCLR, which is X. Rate has gone down, reflect that reduction of rate in your MCLR. So your cost of funds has gone down. Reflect that when you are lending. Rate has gone up, reflect that. So marginal cost of funds lending rate is whenever the RBI changes the repo rate, the same has to be reflected in the rate at which the commercial bank lends. Marginal, that is the extra or incremental, the change in the RBI has to be reflected. So I am watching. If the change is passed on, I know. Not passed on, I know. Tell me, why have you not passed on? So I'll hold you accountable. So that the MSME guy benefits from the policy that's meant to benefit him. They were not doing that also. Why will they? They are seasoned guys. Then the RBI, follow this, it could come. External financial benchmark. Okay. External financial benchmark means I want a loan for 6 months. So what will you charge me in the form of interest for the 6-month loan? Charge me the 6-month government treasury bill. How much is it attracting? You charge me that. Not more, not less. Is it not? I've sold the 6-month treasury bill to you and I've borrowed money. How much am I paying? 7%. So whoever is borrowing for 6 months will have to pay a rate of 7%. So this is the dynamic rate number 1, reflects the conditions in the market number 2, and there is no hanky-panky here, there is no negotiation, just pay the rate as external financial benchmark indicates. So all this the RBI is doing to ensure that the monetary policy that it makes is finding effective transmission into the market. I remember making a graphic, Dharmendra. Have I sent you on transmission? No. Yeah, I could not because partly there is no time. You know, I made a graphic, I know, but it disappeared. But then it would have had only this. What is monetary policy? Transmission, benefits, challenges. Challenges, you talk of NPA. Challenges, you talk of the creditworthiness of the MSMEs. What has the RBI done? These 3 things. These 3 things. All in one place. You know, I will try to put up on the website a graphic. Even otherwise, this is what the transmission challenge, transmission mechanics are about. Take your time. Activate your monetary policy thinking.
So could you please explain external financial benchmark again?
Which one?
External financial benchmark.
So you see, what is the rate you will charge? You have your own cost of funding, this and that, your operations, repo, all that. But that's not, you're not factoring all the ingredients here. So, seedhi baat. You know, you are lending for 1 year. And government is also selling, RBI is also selling a treasury bill for 364 days. Here is the bill. You guys are the market. Here is the bill. I want you to lend me for 364 days, which is 1 year. How much do you want? 7%, 7.1%, 7.2%. So I want to pay you as little as possible. You want to draw as much as possible. So we all settle at 7.05%. So a treasury bill selling for 364 days, money is being borrowed at 7.05%. So all the commercial banks, when you are lending for 1 year, charge this much. That's it. So there is no problem after that, because you can't manipulate a treasury bill rate. That is about the most truthful reflection of the market. Then you may say government is so credible, so we are lending for 7.05. This guy is not so credible. Government is zero risk. Then you do what we will allow you. We know the government is zero risk. We know Reliance is not zero risk. We know XYZ is not. To that you could add a little bit, we can negotiate, but keep this as the benchmark. Yeah? Got it?
Yes.
Yeah.
Sir, shouldn't there be any upper limit also, like the base rate? So
Upper limit for what?
for charging the rates on MSME or such sectors?
See, I am XYZ, not so credit worthy. You are the bank. Yeah? You won't give me the loan. I want the loan. You won't give me the loan unless I pay X amount. So generally there may be, RBI, there must be some informal rules or maybe formal rules, etc. You can't charge more than this. But then leave it to the bank. Interest rates are deregulated. You can tell them MCLR, external financial benchmark, base rate, all this. Beyond that, you can't put a number there. Imagine a bank charges you excessively. Then market is the, regulator. No? They have to see. They won't charge you excessively. They'll tell you X, Y, Z factors, your creditworthiness, your business, your future, all that, linked to that. This is a set of facts, so we'll lend you at X, Y, Z %. Isn't it? Microfinance people, they charge more because a lot of factors.
Sir, base rate are set by individual banks or RBI?
Which one?
Base rate.
Individual. XYZ, ABC, MNOP, you are all banks. Your cost of operations, you operate in a semi-urban area. So your base rate is X. Somebody operates in Nariman Point. Why? So whatever your base rate, you tell me, 20%, 10%, 9%, whatever it is you tell me, don't lend below that. So that I know that you will not, deny the credit to the MSME guys by dipping below, charging more. You got it? Yeah. Take your time. Our next focus.
Sir, what is the frequency of setting these rates?
Frequency of
Setting this base rate or MCLR?
whenever the RBI changes the rate. See, my only interest is when I make a change, let the change be reflected. Because it will be a factor in setting your base rate. When I am borrowing from the RBI at 6%, my base rate is X. When I am borrowing from RBI at 5.75, my base rate is correspondingly lower. Don't lend below that. You got it? Yeah? Yeah. Take your time. Our next area is money market, capital market. We'll go into that. I'll give you, because you're showing lots and lots of interest, another minute is also warranted. What loan?
All types of loan.
All types.
Yes, sir.
I'm the bank, you guys are there to take the money and I'm lending to you, this is the loan. Now what's the question?
Sir, we based on external benchmark based rating.
Yeah, that is a suggestion and they have not made it compulsory, they have introduced it. After all, it's up to the bank. You want to go by MCLR? Be accountable. If I find something wrong with you, I'll impose external financial benchmark. So, RBI can't twist your arm. After all, you are the banks, you are the lifeline. So, external financial benchmark is another benchmark introduced by the RBI that can be adopted by the banks. After all, you are the banks, I'm the RBI, you have to be accountable to me. Let's work it out. These are the channels of accountability. So how would you like to be accountable to me? MCLR, go ahead. External financial, go ahead, whatever. So basically RBI and the commercial banks sitting down together, working out a methodology under which the rate changes and other monetary policy changes are passed on. Because what's the idea? I'm sitting here in Bombay, you guys are spread out, I make a change, I expect the economy to be impacted, but you're not budging. So what am I doing? Is it not? That's the reason.
Sir,
Yeah.
sir, but sometimes when you go to the bank, they charge you like a floating rate or a fixed rate. So floating rate is like depends on the MC level.
Floating rate is whatever, all this external financial benchmark, MCLR, all that. Fixed is under all circumstances 6%, 7%, 8%. So, depending on the bank, you want a fixed, you want a float. The other day RBI guidelines had come. Somebody is taking it on a fixed rate, he wants to shift to float and this and that. You have to tell him, you have to leave him alone, you have to allow him, should not penalize and all that. Yeah? Fixed is fixed under all circumstances. Float is, link it to whatever, either MCLR or external financial benchmark or a mix of both. All that. Got your answer? Yeah.